whether the markets would be able to maintain their very strong opening. Well, they almost have. After the first 20 minutes of trading, the markets continue to hold very close to that 8,100 mark, which means the 0.5% gap up opening is more or less maintained, give or take a bit. So where do we go from here? The expert who is joining us now, our market master, is Tushar Pradhan, the CIO of HSBC Global Asset Management. Good morning, Tushar. Thank you very much for joining us. Well, you just heard what the Power Grid management was telling us. What is the sense that you are getting in terms of capex generally? This seems to be the only company which is talking of capex. Everybody else is talking of emaciated order books. Are you getting a sense that the earnings growth that we have been waiting for is going to get postponed?
No, I think it depends on which kind of term that you're looking for where it will get postponed for. Clearly, I think the expectation that we had for FY16 is not likely to be fulfilled. So it is going to be a picture which will emerge only in FY17 in terms of what it's likely to be. Just one dose of reality I'd like to just add is that when you talk about capex, the capex turning into earnings growth for companies comes with substantial lag. So you mentioned about the capitalization rate, so it depends on the capitalization itself for the company who's doing the capex. And even for companies which are providing the equipment for this capex, for them as well, it comes with a lag in terms of when it'll end up in their earnings. So I think even if the capex does start, and that's where the debate is that when will it start, and even if it does start, the reflection of the same in the earnings is going to be, so many quarters later. So I think the whole picture looks to be that we are all in a wait and watch pose.
Well, I admit my argument was weakly connected, but basically this earnings season as well, we understand 2/3 of the companies have lagged earnings estimates. We will probably have more downgrades than upgrades. You think at the end of this season, will the third quarter at least be different?
No, I can't see why the third quarter will be any different, because the pickup, as I said, even if it starts in the second quarter, because what we have seen in the second quarter is just a little bit of a dip compared to expectations. But if any activity begins in the third quarter as we go into it, then the reflection is yet to come probably by the fourth quarter of this year and maybe the first quarter of next year. So again, ending December, I still don't see any change from what we have seen in the second quarter so far.
Okay, fair enough. By the way, those were some images and footage that you can see of the Finance Minister Arun Jaitley opening the World Economic Forum Summit that begins today. This is an event... Okay, for now he's opening a bottle, but this is an event that will see a participation of more than 250 stakeholders and leaders, including all the union ministers. So we'll cut across to that as and when he begins speaking. But Tushar, hi, morning. We are seeing some amount of momentum flag off, or rather lag in the market. The Nifty for the last 5-6 days has been under quite a bit of pressure. What's the sense you're getting about the later half of the year? Do you think we are in for some amount of underperformance compared to our global peers?
No, I think in the long run, the markets really are a slave to earnings, and we can debate whether an event is going to make the market go up or sustain it or bring it down for the interim. But why the markets have sustained over so long in India have just been the story of very, very strong earnings momentum, which we are not seeing in the past couple of years, which is FY15 as well as now going into FY16. We are seeing that kind of momentum really wear off. So it's giving rise to these conclusions that the markets are expensive, so on and so forth. But let me just reiterate that earnings eventually is where the market will sustain its level. So if the earnings growth is going to come in with a lag, even if it does come with a lag, the markets will sustain simply for the fact that the EPS numbers will get posted up higher. So unless we have a real debate whether the earnings are actually going to go up or not, which I don't think the debate is on really, it's just a matter of time. So if I take the rest half of this year, and to answer your question, what will it look like? I think in the interim, all the events will drive where the markets will go. Again, the debate about the elections, whether that will really be an indicator whether the reforms process will be accelerated or not, whether the US hikes interest rates, whether domestically interest rates start to come off. I mean, there are a whole host of reasons where the market will go in the interim. So if I were to predict, the market for the next half, I would not.
And now I'm not asking you to predict the markets. You explained very eloquently that you don't see any reason why the third quarter should be any different from the second quarter. Okay, Tushar, just hold on. What I was asking you is, you said that the third quarter will not be that earnings generating quarter. Will it be fourth? What's your best guess now?
I think, again, I would just try to temper my comments to the fact that I think the economy as a whole is not really very homogeneous. You mentioned the kind of capex that Power Grid was talking about. I would iterate again that if you look at pockets of the economy, you take infrastructure, for example. I think in roads and in some parts of rail, as well as ports, for example, I clearly see a lot of capex coming in. And that is going to feed into some of the earnings that will actually eventually come up in some of the companies which are listed on the exchanges. So I think if on an average one were to take, I wouldn't really be very far away from where the estimates are now coming to. I don't think there will be significant downgrades from here. But I think the number that we had at the beginning of the financial year, I think that will be at a substantial discount to what will eventually come. I've seen some of the analysts now cover their numbers to a certain extent, which are a lot more realistic than when they were maybe in February of this year. But I think as we go into November and December, the numbers which will come in after the second quarter numbers, the analyst numbers, will more or less remain the same by the end of the fourth quarter. I don't think that to be changing too much.
Okay, I was going through some of the holdings in your funds, Tushar, and one of your top holdings in the HSBC equity fund is Tata Motors. That's actually the biggest Nifty gainer today on the back of a second successive month of good JLR sales in the US region. Is this stock still giving you high risk reward, or do you think that, a lot of the good news is now already into the price?
Well, the way we look at stocks generally is about sustainable profitability versus valuation. So if you take any parameter, you take an ROE, for example, as a parameter for judging profitability, we've seen Tata Motors be one of the highest generators of ROE for a long time. And if you look at valuations, again, if you take a parameter like price to book, say, for example, I think that also indicates that it is a lot cheaper than most of the other companies in that area. And if you look at the trends, one of the things that come very, very clearly is that luxury items, whether the economy is up, whether it is down, it generally tends to sustain no matter what happens. And I think Tata Motors, now driven largely by JLR sales, I think that's catching the trend in terms of having a very, very sustainable future for it, as long as the model is in demand, as long as the brand is considered to be luxury. So I think this is the trend that we see in this company longer term. And of course, there are cyclical events that we need to be ready for. But I think we still feel pretty comfortable about the luxury space in general. I wouldn't really want to make any comments specifically about Tata Motors. But the point is that our view in about what will sustain profitability is more important for us than what happens to any company at any point of time. So just to give a little bit of a long-winded answer to your question, we look at sustainable profitability available at reasonable valuations, and that still fits the bill.
Okay. Well, finally, what is your view on banks? We have seen two rating agencies saying that the worst in terms of asset quality is known, and there will not be incremental bad news. Does that make you a buyer there, especially of public sector banks?
See, I think I'll make a distinction between what the asset quality is all about. So I think we have come a long way from the 80s and the 90s where the assets were suspect. So for example, when you had an asset quality problem with banks, the issue was whether you have collateral. And most of the time it was fraudulent, most of the time the assets were just not there. But today, if you look at the known asset problem, you realize that the assets very much are on the ground. They have either an issue of a startup issue, or they have a regulatory issue, or they have an arbitration issue. But the asset is there, and it can be valued at any point of time for somebody else to buy it at any point of time. So the banking industry, from that point of view, I don't see that much of a risk to it, as long as they are able to do some M&A, they're able to do some movement of the assets into better hands. And I think if you look at the interest globally, I think there is tremendous interest in India. And whether it's a listed market or whether it's an FDI, I think there is enough capital to go around in the world to kind of look at these assets in a fresh perspective. And that's somewhere where I think the banks will find some relief. So I think financials, a very large part of the market, we definitely look at it positively.
All right, Tushar, we leave it at that. Thanks for joining us. Well, that's the word coming in from HSBC. The biggest trigger for this market now is revival in earnings, and that's the only way stocks can grow here on. Well, for the markets, it's still holding